Hi, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin, your host. Um, we got a chart of the S&P 500 up, and we're going to go over that right now. But later on, I'm going to go through pretty quickly, but later on I've got a little presentation. We're going to do the first part of it today, and we're going to talk about trend. So I'm going to probably not spend as much time on the markets. And I'm probably gonna give a little bit of opinion here and be kind of strong about it, so that if there's any of you that are on the fence, you can maybe hop off the fence and get on one side or the other. All right, so here's the S&P 500. As you can, actually that's not the S&P 500. That's the SPY probably. So let me get out of that and get in the right thing. I was looking at the SPY before I got on here. So now we've got the S&P 500. So let me get it kind of positioned in a good spot. There we go. So you can see we had a very big up week. I think the Dow was up 600 points and the S&P was up about 80 or something like that. Maybe a little less. But what we've got here, one of the things I want to point out is we've got the first channel that broke here is this blue channel, which was the shorter term trend. And what was interesting about this channel break is it broke right here, and then it kind of retested here and then moved away. And that's pretty typical. We'll probably see something similar on this larger channel, provided I've drawn it correctly. I mean, we could see the market, drift up into here and then sharply sell off. So it's hard to know. I mean, it could just gap up a little bit on Monday and then sell off, or it could maybe have a short down move and then an up sequence that would take us up to the lower part of this trend line. But the trend is definitely in. We're going to talk about trend today, and I think the bull market is over as we've been experiencing it. Volatility starting to pick up. And we're probably in for, a multi-year bear market. So, Merry Christmas and Happy New Year. I know that's probably not good news for most of us, but it is what it is. All right. So, our target, just to refresh, is down here around 1800 on the S&P 500. And that's because this is where the fourth wave low is. And typically, once you break the smaller fourth wave low, which is right here, which we clearly broke through that, that support area was around 2500, and we blew right through that. So once that happens, generally the whole pattern gets reversed, which would be down here below 1800. All right, so let's look at volatility, since we talked a little bit about volatility. Volatility came in a little bit last week because we had an up week, and that generally is what happens. So volatility tends to increase when the market sells off, and that's because the world is mostly long the market. They're long bonds, or long stocks, indexes, things like that. And when the market sells off, there's a demand for protection, namely puts, and that causes a spike in volatility. Causes a spike in implied volatility too, for the individual options that people are buying protection on, but it causes this overall spike in volatility for the broad market. All right. I guess we can look real quick at Germany, Japan, and United Kingdom. They rallied as well. We've talked about this before, but I think really there's a lot of people think, Peter Schiff namely, thinks that European stocks and Australian stocks and stuff like that are going to outperform the U.S. market, which they very well could. But that might mean instead of going down 80%, they only go down 60%. So my personal opinion is that the event we're headed for is probably more of a worldwide scale type event, and the only safe place to be is going to be in cash, or you can buy a position that shorts the market, plays it to the downside. By the way, if you want to know how to do that, if you just go to Google and you just type in short ETFs, you can get, or maybe inverse is a better, inverse ETFs. Yeah, so you can get a lot of information in here. What are the best inverse ETFs? The SH, the SDS. The SDS is ultra short. In other words, it goes up 2% if the market's down 1%. The SH is just a 1-to-1. I would not buy. SDS is really the only multi leveraged ETF that I would buy, and I'll show you why. Let me find another. Let me find a 3x ETF, and I'll show you why. I don't trade them, so I'm not as familiar with them. Well, I'm not seeing them here. Let's do inverse Dow ETFs. So let's just click on this website real quick. I've forgotten all these names, that's why. So SDOW, DXD. Let's look at a 3x, a UDOW. Okay, so let's go over here and look at a UDOW, and I'll show you why you want to stay away from these. Let's look at a daily chart. Well, let's look at a 1-year chart. Well, it's not. Let's see if it's not as apparent. Okay, it's more apparent on the SDS, but notice how this is just constantly bleeding down. Let me go to a 10-year. Even though the market's rallied, even though the market's sold off quite a bit, we're just barely off the bottom, and that's because they have to buy futures and sell futures to mimic this inverse pattern. And so what happens is on a day-to-day basis, it's fine. But if you held this for a long period of time, eventually what would happen is just your money would just go away, even if you were correct in the direction of the market, because the expenses on these 2 and 3x ETFs, they're just very high, so they just constantly take your money. So that's why they're sloped like this. The SH is also like that, but you're not going to have as much trouble with the 1-to-1 type of accounts. I would just stick with those. But even then, you wouldn't want to hold these for like multiple years. You'd want to buy them for like the swing down, and then when the market started to rally, you want to sell them. In other words, you could buy like an SDS now and ride the SDS up as the market goes down into this area. But as soon as you get down in this area, I would go ahead and step to the sidelines, sell that position, and then maybe buy long SPY back up as the market retraces the first sell-off. I hope that's not too confusing, what I'm saying there. So I'm not intending to be confusing there. Let's look at the short-term Treasury. Let's get back on our normal chart here. Let's go to the 5-year, weekly, get it off log. So, we talked about this last time. The short-term Treasury is kind of trading sideways, sold off a little bit last week. We could get the Fed pausing as a result. Again, the 10-year Treasury, I'm looking for it to pull down into this 2.6 area, but that'll probably be the last pullback, and then it'll be to the upside after that, most likely. Okay, all right. So let's put it back on the S&P 500, but then let's look at our presentation. So I wanted to talk to you about the most important things you need to look at on a chart. And I'm going to break it up over several weeks. Today we're going to talk about trend. Trend is the most important thing that you want to be able to identify on a chart. And you can do it just by looking at it. Like if your eye is trained to see the trend, you can use. Let me turn quick toggles back on, and I'll show you. Sometimes I use. Where is it? Hide studies. Okay, that's it. I don't want to hide studies. So there's a lot of lines on the chart here, but if you notice, there's up here it'll say 30, 50, and 200. So I have the 30-day moving average. Well, we're on a weekly chart now, but if I was on a daily chart, this would be a 30-day moving average, 50-day moving average, and a 200-day moving average. The 200 is way down here. You can see it right down here. And these moving averages are used a lot. In fact, look where the market stopped going down, right on the 200-day moving average, and then bounced. So that's not uncommon. But a lot of traders, what they'll do as soon as you get a break of the 50-day moving average, which is this red line right here. Let me zoom in a little bit. So if we look at this right here, here's the 50-day moving average right here. And isn't it interesting? You can see we broke through it, and then we retested it, and then went down and tested it actually again, and then went down. So this is very common. You get a break of the 50-day moving average. Some people just go, I'm out. Because sometimes it could go down and just go down. But in this case, we retested it 2 other times, which happens a lot. So the 50-day moving average is clearly important. You can see market participants are focused on that 50-day moving average. So you can use moving averages to help you identify the trend, or if you're above the trend or below the trend. I'm going to go ahead and take this back off, just so it's easier to see the trend. But let's go into the presentation and just talk a little bit about it. Let me get this out of the way a little bit. So I've kind of subtitled this "Lessons for Actively Managing Your Retirement Account Made Simple and Easy." And so that's the purpose. What you want to do is you want to have a simple, something you can follow that's simple, something that you can be disciplined around, that doesn't have too many, well, maybe this and well, maybe that. You want to just be able to take action. So that's what I mean by made simple and easy. All right, so trend. And I've already said this, but trend is the most important feature of a price chart. If you're investing money, you want to be aligned with the direction of the trend. Now, your 401ks and IRAs and stuff like that, the types of instruments you have in there, you only really have instruments that are aligned with an uptrend, okay, a bull market. There are no real, short type instruments inside of, inside a 401k or an IRA, unless you have a self-directed IRA and you have that tied to a brokerage account or something. But if you work for a company and you can move your money, from this to that, and those are usually bull market type funds. So most of you are going to be just focused on, aligning yourself with an uptrend. And if the trend starts to change and go down, your option would be to just remove your money from those instruments and put them in a money market fund that's tied to cash. Now, what you'll need to be aware of is that your 401k especially has rules. So things like you can't go in and out of the same fund within a 30-day period, stuff like that. So you want to make sure that you you understand those rules, and that when you take action in your 401k, that you're not putting yourself in jeopardy of not being able to do something that you want to do down the road. So just understand those rules. They're pretty simple. You can usually go into your money market fund, but then if you go out, let's say you go out and back into a fund that's aligned with the bull market, and then you go back and then you try to go back to your money market fund and it hasn't been 30 days, you won't be able to do that. So in general, what you want to do is you want to be able to follow the trend, and you don't want to be making a lot of changes in your 401k. 2 or 3 types of changes in a year max. Okay, so you want to have and then that's all about developing some sort of system. But let's get back to trend. So uptrend is a series of higher highs and higher lows, which should make a lot of sense to people. If you think about it, it's just a staircase, right? It's up to some value, some price value, a pullback, but to a higher low, and then a run up a little higher, and then a pullback to a higher low. This low is higher than this low, and then another run up, and then another pullback, and then another run up. So that's an uptrend. Now, the question becomes, how much of this kind of a pullback am I willing to take to stay in the uptrend? And that's a question only you can answer for yourself. And so, some people just put a hard number on it, like if this pulls back more than 5%, I'm out. If it pulls back more than 10%, I'm out. Or there's some other techniques, and we're going to talk about those techniques that help you stay in the trend or get out of the trend if the trend is looking sketchy. And a downtrend is just the opposite, right? So a downtrend is a series of lower highs and lower lows. So, oops, I did the wrong thing there. Let me get that out of the way. So a downtrend, looks like this, where you have a lower high. So this is the high. You made a lower high, and then it comes down to a lower low, rallies to a lower high, and then goes to a lower low. So that's a downtrend, just the opposite of an uptrend. It should be pretty straightforward. And then there's a trend that not many people are aware of. It's a sideways trend. It could be also known as a price consolidation, where price tends to trade between highs and lows. So, price consolidation, and so the market tends to go up and then consolidate and then resume the uptrend. So you could have a situation where you're making higher highs and higher lows. Okay, and then the market drops. Looks like it's making a lower low, but then it makes about the same low. It could be a triangle. Okay, so this is one type of, but generally these are price continuation type patterns. So if you get something like a triangle, that's just telling you that price is kind of taking a break, and most likely the trend will continue. Okay. Now, other types of price consolidation might be, where it's, you've heard of this double top, double bottom. You get triple top, triple bottom, but it's the same thing. It's just now the price is consolidating in a sideways pattern, but it's still a price consolidation, and most likely those resume to the upside. Now, they don't have to. I mean, you could get a situation where, whoops, I keep hitting Control X. You could get a situation where this breaks out a little bit, so above some high like this, and then turns around and fakes out and goes down. So, but most of the time, I would say 70+% of the time, those are price consolidation moves, and and it's something that you should expect to see in the market as you're following your positions. So let's go and let's look at trends. So this clearly is an uptrend. You can see. That's the thing about trading or investing, is in hindsight, everything's perfectly clear. The problem, the reason trading and investing are so difficult is because you have to you have to do them. You have to make your decisions at what we call the hard right edge. So let's say this line represents the hard right edge of the page. So you're right here, and you don't know about all this, right? You just know that, well, it could go up or it could go down tomorrow. So making those decisions at the hard right edge of the price chart is where the rubber meets the road, so to speak. So, if I let me try this again. So if I move this over all the way over to the hard right edge, you can see, there's no way to know what's happening tomorrow or the next day or next week or next month. So making your decisions is a little bit more challenging. And, everybody's a genius after the fact, right? That's why these guys sound like geniuses on TV, is because you're not actually with them, sitting next to them when they're making their decisions on what to do at the very moment that they need to do something. Of course, there's the downtrend. I didn't do a sideways trend, but here's a downtrend. It's clearly down. And most of your 401ks, if you're in a 401k, you need to be aligned in something that looks like this, because most of the instruments, like I said earlier, are bull market type instruments. They're not short instruments like this. Okay. So noticing a change in trend, that's kind of where the rubber meets the road, right? So how do we know when there's a change in trend? How do we make decisions around a trend change? Well, there's some ways that can help you. You can use moving averages, which we talked about a second ago. We'll talk about again. You can use a pattern crossover technique, which helps people that lack a little bit of discipline to be a little bit more disciplined. And I'll show you both of those. Or you can just observe the price. You can just look at the price structure. You can see that, hey, I'm making, I have a high and I have a higher low, but now I've got a lower high and the market appears to be rolling over. Okay, well, you can take action. And I'll give you an example of where it's good to do that. Let's say you're in an uptrend. Okay, let's say the market is in an uptrend. So you're rocking along and you're doing this, and then let's say your pullback looks like this. Let's say you get a pullback that goes like this, and you make a lower high. Okay, and it starts to roll over. Well, one of the things you'll learn if you really look at markets a lot is anytime you get an ABC, the C is very strong in an ABC. In other words, an ABC looks like this, where C is much larger usually than A or B. And because that's the case, you can begin to take action as early as right here if you wanted to. Okay, you could begin to take action right there. Or you could wait and take action right here. The problem, the later you take action, the harder it is to get back in my opinion. And you get chopped up a little bit more. So, but just in its simplest form, a change in trend is, here's a high, I come back to a higher low. This low here is higher than this low, and then I start to rally, and maybe it starts to chop a little bit here, and you kind of get one more push, but then it starts to roll over. Well, this is potentially, notice I said potentially, a change in trend. Not yet, because what do you need, right? You got a high. Okay, I got a high right here. I have a lower high. A low. This is actually, hold on a second, I screwed that up. This is a higher low, right? And it's higher than this low here, so it's a higher low. Well, now I have a lower high, don't I? So what do I need? What do I need still? I need a lower low. I need something down here that says LL. Okay, so that's why I said potentially this is a trend change. So, for it to officially be a trend change, I need something like that, where this low is lower than this low. Now, even this, again, because I said it's an ABC, if it's an ABC, this could just be a big pullback and a resuming uptrend. And this is what makes things difficult. So what you have to decide is where you're going to take action. Are you going to take action, here? Are you going to take action here? Or are you going to say, I'm not going to take action until I break this low? Obviously, the longer it is you wait to take action, the higher your loss, right? So let's say this whole pattern from here to here took 6 months. So if we don't have a pullback and this actually travels below here, we just lost 6 months worth of gains. So you have to decide, and it has to be something that works for you. Different people have different, risk tolerance and levels of threshold. People do different things. If you have certain skills, let's say it starts to roll over right here, and you know how to do covered calls, you might sell a call right here, an out of the money call. Maybe 3 weeks. The theory being that this down up before I get back to the call is going to take more than 3 weeks. So I sell a call, and that way, if I do have to wait till I get to here, well, at least I made some money on the call. I offset some of that loss. So there's different ways of handling those types of decisions, but everybody has to make their own decisions. So whatever your strategy is, it's important to decide and take action. If you don't take action, then what happens is you get stuck in the psychology of things. And the psychology is, well, maybe it'll bounce back, or if it bounces back, I'll sell. And then it doesn't, and let's say it bounces back and then you don't sell. And then that's even worse, right? Because then I should have sold. So when you get stuck in the psychology loop, you don't want that, because that's not productive. Then it's hard to make money when you really don't have a plan. Trading and investing is a decision-making process involving risk, reward in the face of uncertainty. It is probabilistic in nature. This is what people have the most trouble with. They have trouble making decisions based on probability. Well, what if I'm wrong? What if I lose money? What if this? What if that? So it's very different. That's why I said you need to set something up for yourself that works for you, something that you're comfortable with, so that when you see that negative number in your account, it's not going to freak you out. It's not going to make you go into emotional overdrive mode. It's just going to signal you that you may need to make a decision. This is another important point. There is no way to be certain, and this is why it is so difficult for many people. There is no way to know. There is no way to know the future. Nobody knows the future. The Fed doesn't know the future. Robert Prechter doesn't know the future. Peter Schiff doesn't know the future. Anybody that you listen to, Jim Cramer doesn't know the future. Nobody knows the future. So you have to make decisions in the face of this uncertainty that is the future. And this is why it's so difficult, and why it requires discipline. But it requires more than discipline. It requires a plan that you then are disciplined to. So discipline with no plan is nothing. If you're just disciplined, but you don't have a plan to be disciplined to, then you really don't have anything. So it's important to come up with a plan. I'll show you a couple. Here's a moving average plan. Now you can change these moving averages. I can't remember what these moving averages are. This is the S&P 500. But the idea is when the fast line crosses below the slow line, you get out. When the fast line crosses above the slow line, you get in. Now obviously you can see here, let's just look at this. You can see that this is you lose money on this, okay? All strategies lose money. Let me say that again. All strategies lose money. There is no way to not lose money. It's impossible. Consistently over time. You have to be willing to lose money in order to make money. So if you look right here and you see, okay, well, the cross happened there. So let's just say I got out at the open right there on this bar. Okay. So the market sold off. I'm thinking, God, I'm a genius, right? Well, then it bounced, runs all the way back up to where I sold, and then sells off again, but to a higher low, right? And then it starts to take off without me. But my line hasn't crossed yet, so I'm still sitting on the sidelines. And then it starts to sell off, and I feel like a genius. But right here, right where this cross takes place, this is where I have to buy. So let's just say right here somewhere. I can't really see where those lines are, but let's just say right here. Well, notice that there's a gap here. There's a gap between, and I didn't even draw it in the right place. There's a gap right here to right here. And this is the money that you could have made had you just stayed in. Okay? Now, people say that all the time. Oh, well, you got out. You missed this, but man, you didn't get back in until later, and so you lost this money. You didn't make this money. Okay, I'm gonna say something really important here. Making money in the market is not about this. It's about avoiding this, because you really don't know. You don't know how deep this can go. Okay, and so what you're trying to do is you're trying to control your risk. You're trying to say, okay, I'm going to let this thing wiggle around a little bit, but I'm not going to let it wiggle around more than whatever your criteria is. And if it does, then I'm going to make a decision to step to the sidelines, because I don't know. I could get a really deep sell-off. There's no way to know, okay? And so I have to be able to take action. Now, if you're disciplined enough to get back in, you get back in here, you get a pullback, but you don't have a cross, right? So you're pissed at yourself. I mean, this is just the psychology of it. You're like, gosh darn it, it's pulling back again. But then it quickly bounces, and you're up and off, and you're doing better because, and I'll give you a little hint. When this is widening, the gap between these two, notice this one starts to curl and go up, but this gap is widening. And then once this curls and goes up, once it starts going up, the gap is still widening. This is a good sign. This means you made a good decision. Okay? By the same token, when this gap is widening to the downside, you need to be on the sidelines. Now, I know some people, what they do is they'll get out when this crosses, but they'll get back in when they break above the fast moving average. So they would get back in right there. And that's fine if that's your technique. But I'm gonna take you back to what I said earlier. If you're in a 401k and this goes up and then rolls back over, just realize you can't. If it hadn't been 30 days, you can't go back into your cash. Okay. So whatever your system is, it needs to not create too much activity. It needs to create very little activity. But there's nothing wrong with getting out when this crosses down and then getting back in when the price crosses back above the fast line. That's perfectly legitimate. And in this case, you would have made the extra amount of money would have been made would be from here, to here. So you would have avoided the losses. You would have avoided all this loss and all the sleepless nights and everything. And we got back in here and captured this much more than somebody that would have just stayed in. Okay. And that's good. That's part of investing. But you have to have this plan up front. You have to know that that's what you're going to do beforehand. Okay? And this is not a bad plan, by the way. Give it, set your moving averages up. This could be a 30-day. This could be a 50. This could be a 50, and this could be a 200. I mean, just whatever you want to do. Okay? The bigger these numbers, the fewer signals you'll get. And the more gentle these slopes will be. You won't have these really deep slopes. But let's just assume this was the 30-day moving average, okay, and this was a 50 right here. So when the 30-day moving average crosses below the 50, I get out. So I'm out, and I'm feeling good, man, because I'm sleeping and I'm feeling like a genius, right? The market it finds a bottom, it starts making higher highs and higher lows, it crosses back above the 30, and I'm in right here. And in this case, I would have stayed in, right? Because I didn't get a cross back. The gap is, look, one of the things I want to point out here, let's say you got back in right here. How do you know you've done the right thing? Well, initially the gap widens right here, right? But pretty quickly it starts to narrow. See, the gap between these lines is starting to narrow. And as long as that's happening, you know that you've made the right decision. And then, of course, right here it crosses. This crosses the slow average, right? And then again they're widening, which is a good sign. So that's one technique. Sorry about all the lines. Another technique is you could automate this in your brokerage system, where you could you could actually have it create an arrow for you, when it's time to do something. Here's an arrow getting out, and you're out, and then here's an arrow getting back in. Okay, so this is not a bad system. I mean, look at you missed all of this, right? And you actually improved your position this much, right? You improved your position this much. So these moving crosses work really well. Tends to give you a little bit more signals. You can see here there's quite a few more signals. Here's a sell, here's a buy. You might get a few more signals on a crossover technique, but the idea is the same. All right, support and resistance we're going to talk about next time. All right, I wish we were doing this live so I could ask if you have any questions, but we're not. So hopefully you absorb that. It's very, very, very important to have a plan. Your plan is your plan. You can talk to other people about what their plan is. The problem with most people in 401ks and IRAs, though, is they don't have a sell plan. They're just always in, always. And again, the problem with that is, sometimes you have big bear markets and you don't want to be in, right? You're not sleeping at night. You're worried. Maybe you're only 10 years away from retiring, whatever the situation is. You just don't want to, you want to be off the train tracks when a big bear market is bearing down. And so come up with a plan. Think about it between now and next week. Come up with a plan. Decide, what your plan might look like, and start kind of developing it, and start using it. And I think you'll find that it'll work better. You won't worry about it as much, and it'll help you identify trend. And then when somebody says, hey, when you say to somebody, I am on the sidelines and I'm not in the market right now, they could ask you, why aren't you in the market? The economy's doing great. Shouldn't you be in the market? Well, the trend has changed. And then just leave it at that. The trend has changed. I invest with the trend. The trend has changed. It's clearly down, or it looks like to me it's going to be down. So I've stepped to the sidelines. That's all you need to say. You don't have to predict the future. You don't have to say, I think this or I think that. Just the trend is down. And that should be sufficient. So, and logical. I mean, nobody could fault you for, being out of the market if the trend was down. I mean, a lot of people wish they were out of the market after the trend has been down for a while. So don't feel bad about saying that to somebody if you have to. Okay. All right, everybody. That is it for this week. Thank you for coming in, and hope to see you next week. We'll go over the markets real quick again, and then we're going to talk about support and resistance. Two very important concepts in trading. The second most important thing you'll see on a chart is support and resistance. We touched on it a little bit today, where these moving averages can provide support, just like we saw over here on the S&P 500. I'll show you just to remind you. Let me put the studies back on. So notice right here, Remember, I told you this is the 200-day moving average right here. And of course, last week the market came right down to the 200-day moving average within a couple of points, went through it just barely, and then bounced and rallied like 600 points or something on the Dow. So very, very common to have these moving averages provide support and resistance. We also talked about the resistance that the 50-day moving average provided here at these multiple points. So we'll talk a little bit more about that next week. We'll definitely cover this resistance. There's a couple of tenets that you need to know about support and resistance, and it really is important. So you want to tune in next week, and we'll be going over that. All right, everybody. Thanks for coming in. We'll talk to you next week. Bye-bye.